In January 2021, Peloton was worth almost $50 billion. The stock traded above $160 a share. The company had just raised $1 billion in convertible bonds at a conversion price of $239, a number the stock would never reach again. The market believed Peloton was a technology company. The market believed the gym was over. The market believed the future of fitness was streamed from a Manhattan studio onto a touchscreen bolted to a $2,000 bike that lived in every lockdown living room in America. But behind the velocity, the company was making one bet: that the lockdown would never end, that the bike in the living room would never move, that the future they had built in 18 months of pandemic would last forever. It would not. The bikes ended up in the garage. This is the story of how one lockdown bet destroyed a $50 billion fitness empire. Peloton was founded in 2012 by a 41-year-old book publisher named John Foley. The insight was simple. He hated going to the gym. He wanted a SoulCycle class in his living room at 5 in the morning. The product was a stationary bike with a touchscreen mounted to the handlebars, streaming live and on-demand workout classes from a studio in New York. It sold for over $2,000. The classes required a monthly subscription. The math on paper looked beautiful. Sell the bike once, sell the subscription forever. The hardware was the cost of entry. The subscription was the magic word. Peloton went public in September 2019 at $29 a share. It was a respectable IPO. The stock closed the first day below the offering price. Wall Street was skeptical. The company was losing money. The bike was expensive. The customer base was small. And then in March 2020, the world locked down. What followed was the most absurd growth chart any consumer hardware company has produced this century. Gyms closed. SoulCycle closed. The bike that nobody could justify in February was the only piece of fitness equipment money could buy in April. Waiting lists stretched to 10 weeks. Bikes were resold on eBay for double the retail price. The stock went from $29 to over $160 in 14 months. Foley appeared on every magazine cover business journalism had to offer. The story became a category. Peloton was no longer selling a bike. Peloton was selling the future of fitness. And the market believed it. By January 2021, the consensus was complete. Peloton was the most valuable connected fitness company in history. The market capitalization was $49 billion, briefly more than every traditional gym operator on Earth combined. The stock peaked at $167.42 on the 15th of January. The company had 2.3 million paid connected fitness subscribers. The financial press described the platform in the same vocabulary it used for Netflix and Spotify. Subscription economics. Recurring revenue. The Apple of fitness. The lifetime value of a Peloton member was modeled at numbers normally reserved for software companies. Analysts spoke about the path to 100 million subscribers. Foley said it himself in interviews, with a straight face. In February, the company announced it would build a $400 million manufacturing campus in Ohio to keep up with what it called permanent demand. That same month, it raised $1 billion in convertible bonds at 0% interest, at a conversion price 65% above the share price on the day of pricing. The market took the deal in 2 days. Sophisticated bondholders bought $1 billion of paper from a hardware company at 0% because they believed they were buying the next decade of streaming fitness. They sold a future where the gym never reopened. The market believed them. If you are still watching, you are exactly who this channel is for. Bondholder is new. We are building this from scratch, telling the stories of corporate collapse from the perspective of the people who saw it coming. The creditors. If that is the kind of story you want more of, hit subscribe. You do not just stay in the loop for the next bondholder fight, you help us keep making these. Thank you. But once the gyms reopened, the bike that had defined the lockdown became the thing nobody touched. The unwind happened in 3 stages. and each one was faster than management had any plan for. The first stage was inventory. Peloton had spent 2 years building the production capacity to satisfy lockdown demand. A $400 million Ohio campus was under construction. The week before Christmas in 2020, Peloton had paid $420 million in cash for Precor, a commercial fitness equipment maker with factories in North Carolina and Washington. The deal was framed as a manufacturing investment to meet permanent demand. In retrospect, it was a $420 million bet. That hardware demand would last forever, made at the exact moment that demand was about to evaporate. Warehouses across North America held tens of thousands of bikes ready for customers who, by the summer of 2021, were no longer ordering them. The waiting lists were gone. The eBay premium had evaporated. The bikes were now sitting in distribution centers, capital frozen in carbon steel and aluminum. The company cut the price of the bike by $400 to clear the stock. Margins compressed. The Ohio factory was canceled. Inventory is what optimism looks like when it goes wrong. The second stage was the unit economics. Peloton had positioned itself as a subscription business with a hardware on-ramp. The market had priced the company on that story. But the math required a continuous stream of new bike sales to feed new subscribers. When the bike sales stalled, the subscription growth stalled with them. Connected fitness subscriber additions, which had run above 500,000 per quarter in 2020, collapsed below 100,000 per quarter by 2022. Planet Fitness, the brick-and-mortar competitor everyone had counted out, reported its best quarter in years in May 2022. The same day, Peloton reported a $757 million quarterly loss. The contrast was not subtle. The reopening trade was on, and Peloton was on the wrong side of it. The third stage was the competitive collapse. Lululemon had paid $500 million for Mirror in 2020, in a deal explicitly priced against the Peloton thesis. By 2023, Lululemon had written most of that down and quietly killed the product. Nordic Track and iFit cut prices. The connected fitness category, which had been priced as a software market, turned out to be a hardware market with seasonal demand and a permanent reopening problem. Hardware companies do not get tech multiples for long. The market remembered why. While the equity market was still arguing about whether Peloton could grow its way out of the inventory pile, the bond market had already done its math. The signal came in May 2022. That was when JP Morgan and Goldman Sachs, the same two banks that had taken Peloton public 3 years earlier, syndicated a new $750 million first lien term loan to keep the company solvent. The terms were the entire story. The loan priced at 6.5 percentage points above the floating reference rate, with an original issue discount of 4 to 5 points off par for a yield to maturity of just over 9%. The collateral was first lien. The same banks that 15 months earlier had sold $1 billion of Peloton convertible bonds at 0% and unsecured now refused to lend the company a smaller sum without security, a high single-digit coupon, and a discount. That is what credit repricing looks like in real time. The equity holders, looking at the same balance sheet, were still pricing in a recovery. The bondholders had already concluded the recovery was a hardware problem with a subscription veneer, and they priced accordingly. By the time the equity panicked, the bonds were already gone. The 0% convertible notes from February 2021, originally bought as a synthetic equity bet at a $239 strike, had collapsed in the secondary market within months of the stock peaking. The conversion option was dead. The notes traded as distressed credit, not as call options. The people who held them were no longer betting on Peloton. They were waiting to get paid. In December 2021, a television revival opened with the death of its lead character, a heart attack on a Peloton bike. The stock dropped 11% in a day. The brand had become a punchline. By May 2022, the cash position was the only number that mattered. Peloton had $879 million in the bank. The CEO, by then a former Spotify and Netflix executive named Barry McCarthy, who had replaced Foley 3 months earlier, told investors the company was thinly capitalized for a business of its scale. That was an understatement. The $750 million term loan was the only thing keeping the lights on. The Ohio factory was canceled. Almost 3,000 employees were laid off in the first round. 2 further rounds followed in 2022 and 2023. The treadmill business was hit with a federal recall after a product safety failure. The bike was discounted again. The press shifted from profile pieces about the future of fitness to obituaries about the future of Peloton. The stock fell to single digits. Cash burns fast when the orders stop. McCarthy lasted 2 years and left in May 2024. The board appointed a turnaround executive. Layoffs continued. The product portfolio was cut. The international expansion was pulled back. The company stopped marketing the bike as a lifestyle product and started marketing the subscription as a service that could be used on equipment Peloton did not own. Free apps for the rower nobody bought. Free apps for the treadmill that had been recalled. The brand had survived. The story had not. By the time the stock found a floor in the low single digits, the company had lost more than 96% of its peak market value. The convertible bonds the company had sold at the peak were now coming due. The maturity was February 2026. The conversion option was worthless. Peloton did not have the cash to repay them at par, and the holders were under no obligation to wait. There is no recovery from a lockdown you cannot relock. They sold the pandemic as if it were a permanent condition. The lesson of Peloton is not that it failed. The lesson is what kind of failure it was. This was not fraud. There was no balance sheet manipulation, no hidden conspiracy, no concealed liability. There was something subtler and more common. A company mistook a pandemic for a market. The pandemic was real. The growth was real. The cash was real. The technology was real. But none of it was permanent, and the people running the company priced it as if it were. A pandemic is not a business plan. The same pattern has run through every category that experienced a lockdown windfall. Zoom briefly traded above $150 billion, and today trades at less than a quarter of that. Carvana, the online used car dealer, briefly traded above $60 billion and nearly went bankrupt. The streaming services that priced subscriber growth as permanent had to learn it was demand pulled forward from later years. The grocery delivery services that priced lockdown habits as permanent had to lay off their drivers. Each category had its own version of the bike in the garage. The market will always pay for growth until it learns growth was just demand pulled forward. What separated Peloton was not the misjudgment. It was the financial engineering laid on top of it. The company took a temporary demand spike and used it to raise $1 billion of 0% convertible bonds at a 65% equity premium. It used a pandemic boom to lock in capital from a market that believed the boom was the future. When the boom ended, the capital remained. The bonds did not unwind themselves. The bonds finally unwound in May 2024. Peloton announced a $1.35 billion holistic refinancing. The company issued a new $1 billion 5-year term loan, $350 million of new convertible notes at a 5.5% coupon and a maturity of 2029, and a new $100 million revolver from J.P. Morgan and Goldman Sachs. The proceeds were used to repurchase approximately $800 million of the original 0% convertible notes at a discount to par. Total debt fell from around $1.75 billion to $1.55 billion. The maturities were pushed out 4 years. That refinancing is the wedge this whole story turns on. The original bondholders who had bought $1 billion of Peloton paper at 0% in February 2021 were taken out at a discount. Most of them got back most of their money. The first lien term lenders from 2022, who had charged 9% for a year of risk, were refinanced and paid in full. The equity holders, who had ridden $167 shares down to single digits, had not. The bondholders had been pricing this collapse for 2 years. The shareholders had been arguing about whether to buy the dip. 5 years on, the bike is still in the garage. And so, just barely, is the company.